Hey, Rent to Retires, it's Adam Schroeder here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Rent to Retirement. And we are pleased today to be joined by Tony J. Robinson. He is the co-host of the Real Estate Rookie podcast and one half of the Real Estate Robinsons. Tony, thanks for joining us.
Yeah, thank you guys for having me. And just to clarify, I'm the lesser half of both of those partnerships. So actually, my co-host at the Rookie Podcast is much better, and obviously, my wife. You always got to give her props as well. But happy to be here, guys.
Well, I'm not going down that road to start, so I'll let you steer the course on that one. But tell us, we always like to start off back at the beginning for everybody. Can you tell us a little bit about your first deal in real estate and what about that deal made you decide to continue on down the path?
Yeah, so I guess just even backing up a little bit before that first deal, like most folks, I went to college, got a good career, climbed the corporate ladder pretty quickly, and my last W-2 job, I was a senior manager, had a organization of like 500 people spread out across the country, so like just very busy W-2 life. I was compensated well, but also gave up a lot of time in exchange for that compensation, and I knew that the end goal, even when I was younger, was to eventually have something for myself. I was waiting for the right time, but I think once our personal income got to a certain point, we had the excess funds to do it. We kind of jumped in. And my initial goal, honestly, was to get into apartment syndication. And I read, whose book was it? It was Joe Fairless's book. It's like the best ever apartment syndication book, was one of the first books that I read. And his recommendation was, if you want to syndicate, you need to build a network, you need to build a brand. So I started doing that first before I even had a deal. I had a podcast where I was interviewing other investors about their first real estate investment. And anyway, through that podcast, I learned a lot, met a lot of people, and I ended up getting my first deal, which was a single family home in Louisiana, of all places. I'm in California, but I bought in Louisiana, and that one deal kind of snowballed. But we didn't end up doing apartment syndication because when we tried to make that switch, that's when COVID happened. And there was just like, it was a hard time for everyone in real estate, I think, trying to find deals during that time because sellers were nervous, but even more so for someone who's trying to be a first time apartment syndicator, like, broke, like no one would give us the time of day. So we're sitting on some capital, and one of my friends says, "Hey, Tony, you should think about buying an Airbnb." And he walks me through the numbers on his first deal. I'm like, man, these numbers look really great. And we ended up buying that same summer and just kind of went from there.
Was that the Louisiana deal? Was it Airbnb or was
No,
that
so we bought 4 long-term rentals in Louisiana. Just again, trying to build that track record, trying to have some proof of concept that we actually know what we're doing when it comes to real estate. But the first short-term rental was in the Smoky Mountains in Pigeon Forge.
we definitely want to unpack that, Tony, because that's, I think, your main business model today and really what you've grown a lot of your portfolio in is the short-term space. Sounds like you're doing some really exciting stuff with converting small boutique hotels to kind of this new age model of like a hybrid approach. We want to unpack that. We haven't talked about that at all. But I do want to talk a little bit more about your first deal being out of state. A lot of what we do at Rent to Retirement is help people access deals and coach them through buying properties in states they don't live in. And there's nothing wrong with starting where you live personally, but I consistently argue that, you know, your local market may not be the best market for you based on your goals, based on the market you live in. You are obviously in California, which, there's challenges there as well, from tax legislation, price point, all the things. Not to say it's unreasonable or that you can't make it work, but why did you look out of state? Walk us through that a little bit more. Like, why did you look out of state? A lot of people are scared to buy their first property out of state because of, the unknown. It seems daunting, but why did you decide out of state, and walk us through that process a little bit more?
Yeah, I mean, Zach, you kind of hit it on the head. I mean, it was all the things you mentioned, right? Price point being like the main one. So I'm in the suburbs of Los Angeles, and I don't know, median home price here is far above the national average. And even aside from the affordability piece, it was just the actual return that I could get looking at deals in this market just wasn't what I wanted. So, and obviously appreciation, like if that was my only play, then cool. Investing here would make a ton of sense. But I was also looking for cash flow. And just the combination of my budget and the deals that were available, it made Southern California not the right market for me specifically. I actually landed in Louisiana because my stepfather had some family there. Him and my mom ended up buying a house out there, but they found this bank, and this was kind of the key that drew me to that market. They found a local credit union that allowed them to fund 100% of the purchase and the renovation for this house they found out there. And they were talking, at this time I hadn't done a deal yet, but I've been educating myself a lot about real estate. And my mom just kind of like nonchalantly mentioned this to me. I don't even think she realized the gold mine that she had found. So I started asking more questions. I got the contact from that credit union. And yeah, it turns out they had this loan product at the time where if you found a home and the purchase price and the renovation costs were less than 72% of the after repair value, they would fund the entire thing. And once I had those guardrails around what the bank would approved, I was just off hunting for a deal. And like I said, we're going to find a few deals in that market. But that's what drew me out there. It was the affordability. The first house I bought, I think it was $100,000 purchase price, which where I'm at, I could maybe rent a room for $100,000, right? But I was able to get a 3-bedroom, 2-bath. I think it was 15 or 1600 square feet out there. So the combination of the price point and the lending is what drew me out there.
How did you go about building out your team? I mean, because like Zach said, you're doing it out of state, but not only that, you're doing like a BRRRR out of state. So what gave you as a new investor the concept, I'm just going to go to Louisiana and rehab 4 properties at a time? And that's a real easy first step.
Yeah. I think I'll talk about the tactical side, but first let me just talk about the mindset that I was going into this with, right? So I think a lot of people who are looking to get started put way too much pressure on that first deal. And they go into it with this assumption that everything has to be perfect. It's got to be a home run deal. But I've talked to thousands of real estate investors. The two of you probably have as well. I don't know anyone who's retired off of their first deal. It hasn't happened. So the purpose of that first deal isn't even necessarily to maximize cash flow. Right? The purpose of that first deal is to educate yourself. The purpose of that first deal is to give you proof of concept. The purpose of that first deal is to give you the confidence to do your second deal and your 5th deal and your 10th deal. So I think that mindset that I had going into it made it easier for me to do this remotely because like, hey, worst comes to worst. I just learned a lot of really good things on this deal that helps me for the second deal. So that was like the mindset piece. Tactically, the benefit of going with that bank was that they were a local credit union. So they had a lot of contacts in that market as well. So through them, I was able to find agents, contractors, like all the folks that I kind of needed to put this deal together. They already had that roster. And then what really kind of, I wouldn't say put the nail in the coffin because that's more of a negative connotation, but like what really pushed me over the edge was that as part of their loan, they didn't disperse any funds to me. They would disperse the funds directly to the contractor. But before they did that, they sent out someone from their own team to inspect the work to validate that it was being done. So I kind of had these guardrails in place to make sure that the contractor wasn't doing anything silly. So when you put all those pieces together, the mindset I had going into it, the fact that I literally had, I don't know, I think I paid for an appraisal, a little bit of closing costs, very little money out of pocket, and the bank was going to be there to help me oversee this rehab in a sense. It gave me the confidence to move forward pretty quickly.
Yeah, we talk a lot about finding the right members of your team. That is a huge member to add to your team. If you've got a bank helping you out with all of those things, I mean, that's a massive addition to anybody's real estate team. So, did they fund other deals for you in the future? Like, were they able to help you out outside of Louisiana, or were they just local?
They were very specific to Louisiana and really just to kind of like a certain radius around the city. So if I even tried to go to like New Orleans, which was, the southern tip of Louisiana, they wouldn't work there. So very much regional to their area.
Yeah. Did you know that with the right investment strategy, you can receive strategic tax benefits for your situation while setting yourself up for long-term success this year? At Rent to Retirement, we're excited to share how BAM Capital's multifamily real estate investments can help accredited investors achieve tax efficiency and build wealth. With top-tier properties, BAM Capital helps maximize passive income while offering significant tax advantages through strategies like depreciation and cost segregation. Visit bamcapital.com/RTR today to learn about their offerings to help you keep more of what you earn and make this year a year of financial growth. Have you ever thought about investing in residential mortgages? Investing in mortgage debt offers a consistent stream of cash flow, all backed by real assets. Traditionally, this opportunity has been reserved for institutions and ultra-high net worth investors. But the Reliant Income Fund, managed by PPR Capital Management, is changing that. With decades of experience and over $1.1 billion in assets under management, PPR provides accredited investors with access to passive income through a diversified portfolio of mortgage debt and apartment communities. Learn how the Reliant Income Fund can fit into your portfolio. Visit pprcapitalmgmt.com/rent to retirement. That's pprcapitalmgmt.com/rent to retirement.
Yeah, credit unions, we found that as well, and we work with some credit unions as well in the South that at one point, even for long-term rentals, they would finance 100% of those properties. Now they've reduced it to 95%, which is still significant, but like those are still like those are true investment properties that you can get long-term financing on. And people are scratching their heads saying, or they argue with us saying, no, you're talking about FHA, and like, no, these are true portfolio loans. But credit unions, like they are hyper local to the market that they're in, but they can offer some crazy, advantageous loan structures, and it's always changing. But you're the first person I think we've interviewed, Tony, that has like built their team from a lender recommendation because you heard about a creative loan structure. I think that's fascinating, and it's still like you still had to take the action. It's like even though they brought in 100% of the deal, they have the contacts. Like you still have to underwrite the deal with their guidance. The bank's obviously going to help with that, but like there and maybe have some guardrails, but you still have to have a baseline understanding. Did those? Do you still have those deals today? And did they all work out as anticipated, or do you want to share more on that?
Yeah, no, we sold them all off as we made the transition to short term. Most of the deals were fine. There was one deal that we absolutely got clobbered on. Not so much because anything that we did, but this property, and we didn't know this, or we didn't even know to check when we bought, but this property sat in a flood zone. And the first year that we owned it, we got the insurance quote and it was reasonable to the other properties that we had. But the second year that we owned it, I think our insurance went from like, I don't know, $1,000 a year to like 5,000. Like it was a crazy increase. And we shopped it around. Every single quote we got back was around that same amount. Even though there had been no flood event, like nothing happened, but for whatever reason, all of the insurance companies just saw way more risk with its property. So we said, okay, hey, let's try and sell it. Selling it became a bigger nightmare because during one of the inspections, we found some foundational issues. Long story short, we ended up losing about $30,000 just to sell this property. So talk about lessons learned. But yeah, every other property was pretty good, but that one we took some bumps and bruises on.
Yeah, and I mean, there's obviously risk associated with rehabbing properties, especially from a distance. Like just for anyone that's thinking about doing that, I mean, Tony, you jumped off the deep end and went into multiple, and
Yeah.
you made it work, right? Not every deal you're going to buy is going to be even positive, let alone like a home run. But it sounds like majority of the deals worked out, in a positive nature. And as you mentioned, you learned something from them. I love the fact that you brought up that the first deal is important, just to, like get you in the game and have proof of concept. All the time we talk about like, hey, that first deal is not actually so important financially, but like just mentally and emotionally, it absolutely is. And I truly believe that. I mean, a lot of our investors that they use the turnkey or the built to rent route of like, hey, I'm going to ease into it. They get this foundation and they're like, oh, this isn't as hard as I anticipated. And they go on and do great things, right? But we feel very fortunate in helping them get into that first deal because it is such a mind shift change. Tell us what happened next. We obviously you're still and have been for many years a co-host of the Real Estate Rookie podcast at BiggerPockets. I would say a lot of our audience comes from BiggerPockets, so you probably inadvertently helped them get into that first deal and had a big impact on them. We could say that with absolute certainty. But talk to us about like what's next. How did you get involved with BiggerPockets? Like, tell us what's next in your journey.
Yeah. So again, we ended up buying that first short-term rental in the summer of 2020. So like smack dab in the middle of COVID. And at that point, I'm actually not with BiggerPockets yet, but I'm still running that podcast that I started myself. And then somehow I made a connection through my podcast. I got introduced to the producers at BP, and they were looking for a new host for the Rookie podcast, and that's when I was able to jump on board. I believe in the fall of that year, and then I don't know, fate, whatever you want to call it. But I think it was a month after my first episode aired for BiggerPockets, I ended up losing that W-2 job. And I'm at this like crossroads where it's like, well, what do I do next? It's like I think at that time we had still the 4 long-term rentals. We had 2 active short-term rentals. We're working on our third. And what do we do? Do I go back into this workforce to just chew me up and spit me out and show me how little I actually mean to it? Or do we kind of bank on ourselves and really see how far we can take this real estate thing? And again, this is like a month after I started BiggerPockets. So like my name, my brand, like it's none of what it is today, right? I'm just Tony at that point, you know? And I sit down with my wife and we have like a, you know, just like a heart to heart. And we say, okay, hey, look, this is right at the end of 2020. I said, hey, what if we just take all of 2021? I don't go back to work. We just see how much progress can we actually make in 12 months. And if we're happy with where we're at those at the end of that 12 months, then cool, let's keep going. And if we're not happy, hey, no harm, no foul. I'll go out. I'll get another job. Like I said, we had almost three Airbnbs at the end of 2020, and we got up to 15 by the end of 2021. So just a lot of hustle, a lot of hard work, and luckily we were able to get to a point where I didn't have to go back. So that was kind of the motivation for us. We had a little bit of a fire, you know, lit underneath us, but a lot of hard work went into that those next 12 months to keep scaling.
Can you dive into, I mean, you've got a big sign. If people are listening, they can't see it obviously, but you got a big sign behind you saying humble hustle. Where did you come, like, when did that become, I'm assuming that's kind of your phrase, your mantra in a lot of ways. When did that come into play, and how has that helped you through the journey?
Yeah. I mean, two separate words, right? Like on the humble side, I think it's so easy at times, especially when you're, you know, an influencer, you know, to overestimate who you are and your purpose on this planet. But I think for me, it never gets lost on me the fact that, man, I'm just so incredibly lucky. You know, I'm so incredibly lucky that people care what I have to say. I'm so incredibly lucky that, you know, the stories that I've been able to share have impacted people in so many incredible ways. And I never take for granted the unique position that I have for this very small group of people to help them get to that next phase of their life. And then on the hustle side, I just also believe in hard work. You know, it's like if all else fails, one thing I can always fall back on is my ability to just like run through a brick wall to try and get something done, you know? And that, you know, that has its own kind of double-edged sword. Sometimes you can work a little bit too hard, but I know that I can always fall back on my ability just to buckle down and do whatever work needs to be done. And I think when you combine those two things of immense gratitude for the success that you have with an immense amount of hard work to keep that success going, hopefully it's a recipe to sustain that success for a long period of time.
Yeah, I love that. I mean, it's great to hear the gratitude that you have and being thankful for, you know, I guess you called it luck where you're being at, but I would argue that, I mean, it's the hustle aspect of you seizing opportunities and believing in yourself that really allowed this to pay off, right? But
Yeah.
certainly being humble as you've grown your portfolio and become more of a known brand, like, you know, people appreciate that.
Yeah.
So let's
And Zach,
let,
I just want to add one other thing on the luck part, right? I couldn't agree with you more. I think that obviously luck without hard work doesn't mean much, but I also think that every person on this planet has luck in some way, shape, or form. It's just some of us are better at recognizing that luck and seizing that opportunity. I don't know if so. Like we all know Bill Gates, right? Bill Gates built one of the biggest businesses to ever exist on this planet. But Bill Gates was also a student at the only high school in the United States, I think maybe even in the world, don't quote me on that, but for sure in the United States, that gave access to computers for students. He's one of the only, literally the only high school in the United States where students had just open access to a computer lab. That's luck. You know, it's like he couldn't have chosen that path. He just got lucky enough that his parents chose to put him in a certain high school. The high school made the decision to get this computer lab. That's luck, but he had the foresight to take advantage of that opportunity. So I think for everyone that's listening, we all have different brushes with luck, but sometimes we're so focused on other things we don't recognize the luck that's in front of us. So you've got to be able to take advantage of it when it's in front of you.
yeah, absolutely.
Everybody in his high school could have used that lab.
Right?
If someone's read Malcolm Gladwell, I can hear that story coming through it.
It's being opportunistic, I think, is really what it's about. Because to your point, yes, we all have different opportunities we are positioned. Sometimes you just don't even recognize them. But if you're someone and I think this is a lot of the entrepreneurial journey of being opportunistic. So when those opportunities do present themselves, you act on them versus letting them pass, right? You didn't have to, you didn't have to act on, you know, that first hearing about this lender in Louisiana. You didn't have to, you know, take the position with BiggerPockets and double down on yourself versus going back to the corporate world. So going down the short-term route. So I think that's a common theme I consistently hear from successful people is that yes, they were opportunistic and they acted on those opportunities. My wife is Chinese, and I forget that there's a Chinese proverb or something along the lines, and I won't even begin to try to talk about what that actually is. But the theme is that if you're someone that believes that you're lucky, you tend to be more lucky. Or have, and I think again, it's just that mindset of thinking about your life and being opportunistic. We could go super deep into this, and I appreciate you sharing your philosophy on that, Tony. We want to talk about short-term rentals and what you're doing today, as well as like how your business model works, which I think is fascinating. So feel free to share about how you partner with people. We'd love for you to also talk about the evolution of short-term rentals, because that's a very, I think, niche business that had a lot of hype in 2019 to 2022, and COVID actually really was this huge benefit to the Airbnb industry, and they got a lot of attention. And then there's been a little bit of correction. It's all market dependent. I love short-term rentals. We do a lot with them, especially from a tax side. But talk to us about your journey in short-term rentals, and then like what you're doing today.
Yeah, just on the market piece, I think again you hit a lot of important points there. First, I'll say, yeah, just like traditional real estate, the short-term rental market is very city and market dependent. And we can talk about things on a national level, but it doesn't mean it's true for every individual market within the country, right? But just like nationally speaking, absolutely right. Like post-COVID, as a national, short-term rental economy, we saw some of the highest revenues, right, coming out of COVID. And we did see dips 22 going into 2023. But what we saw in 2024 was a bit of like I guess, stabilization. And even more so in 2025, we're starting to see year-over-year gains nationally as well. And I think what that says is that there were a lot of people who kind of saw this as like the gold rush, where they're like, man, there's a lot of people making money. They all jump in. But if you guys know the story of the gold rush that happened here in California, the majority of people who came didn't make any money. They all came, they were, shoveling for gold and didn't make any money. And I think we saw the same thing happen in the short-term rental space, where there were just a lot of people who, and I don't mean this in a disrespectful way, but there were a lot of people who had no business buying short-term rentals that bought short-term rentals, because it is a very specific skill set that you need to be successful in this space. And if you don't have that skill set, it's fine, but maybe you shouldn't have bought that in the first place. So we saw a lot of people jump in who didn't do it the right way. And I think we saw a lot of those folks exit. Either they sold, they converted to midterm, they did short-term or long-term room rentals, whatever it may be. And we're starting to see that stabilization. So for folks who are looking to get started now, I think there's a little less speculation, because you've got, more data post-COVID to make more informed decisions around performance. And you've got more, maybe better, you've got a better picture of what it actually takes to be successful in certain markets, right? Like we can look and say, okay, hey, we know that this model works really well in this market. This model works really well in that market. So just, that's kind of the state, I guess, of the short-term rental market currently.
So whenever you say there's some people who got in who probably shouldn't have, whenever you look at successful short-term rental investors, what are some of the things, if I'm looking to go into a short-term rental, what are some of the things I should be asking myself about myself to know that I might be successful if I go into it?
Do you like talking to people? Do you enjoy providing hospitality to people? Can you respond in a hospitable way when someone's saying something that is absolutely wrong, right? But you still want to make sure that you're protecting their experience. So I think a lot of people overestimated, or I guess underestimated, what it takes to actually provide good experience. And then I think the other piece too is just how much capital do you actually have to invest? Because with a traditional long-term rental, you've got your down payment, your closing costs, maybe some small like make ready type expenses. But with a short-term rental, in addition to all those same expenses, you also have to design and furnish the place. And I saw so many people who underestimated how much it costs to correctly set up a short-term rental. And they're grabbing stuff from Facebook Marketplace. They're taking blurry iPhone photos themselves. And they're just they spent all their money on acquiring the property, but they didn't leave anything afterwards to actually set it up correctly. And I always tell folks, if you've got, say, $100,000, I'd rather you spend, $30,000 acquiring the property. So go buy a $200,000 property somewhere, right? And then spend that other $70,000, $80,000 setting it up, because that'll give you a better return in most cases than spending that full $100,000 on a larger property that you put nothing into. So I think those are the two big things.
Yeah. So what we just heard from you is that it is quite possible to spend, over double the down payment, depending on the property, on furnishing. And actually that was recommended as to have the right experience, right? And that's something I learned the hard way jumping in is yeah, furniture is expensive, but it's not
Yeah.
just furniture. It's art. It's
Right.
the systems. It's
Yeah.
the marketing, the photos.
Mhm.
Yeah, that's a huge thing.
Yeah.
What else have you seen to be important in today's world to separate yourself from? And I know you're making the transition to some of the boutique hotels. We certainly want to hear about that. But if there's just like a bullet point, a few nuggets of knowledge, Tony, that you can share with people that are just getting into the short-term game, what are a few other things that like stand out from the crowd to help them, whether it's on the property acquisition, setting it up, the listing, the marketing? Is there any like nuggets of knowledge to share?
Yeah, I guess a couple of things, right? One, hire a professional designer. Unless you are a professional short-term rental designer yourself, don't DIY it. Just pay the money, have someone who's an expert in that do it for you. I think that will solve a lot of issues for you, because they're going to know, hey, what are the design elements? How do we make those Instagrammable moments? How do we make sure that your property stands out as someone scrolling through the endless amount of listings in your market? So pay for a professional designer. The second thing that I would recommend is research the top 10% of properties in your market. If your budget allows you to buy maybe a 3 or 4 bedroom, then look at all the other 3 and 4 bedrooms in that market based on revenue, and you can use tools like AirDNA or Price Labs, but look at the top performing properties in that market and identify what the themes are. What are the things that's consistent amongst those top properties? And typically, in most markets, there is some sort of continuity between those top performing properties. And then identify how you can incorporate those into your listing as well. Like, every market's gonna be slightly different, and what someone wants in Breckenridge is gonna be different than what someone wants in Des Moines, Iowa, or what someone wants in Buffalo, New York, right? Like, the actual elements are going to be different, but typically there's some sort of theme across those top performing properties.
Love that.
Whenever I just want to go back to when you really bet on yourself there, we hear a lot. You mentioned you had like 2 or 3 going into it, and by the end of the year, was it 13
13,
that you had?
yeah.
How were you able to, capital is a limited expense for
It
everybody,
is.
and yet
Yep.
you were able to buckle down and in 1 year do that. And that might seem unbelievable or overwhelming to someone who's hearing this. Like, what did you have to do in that year that you were betting on yourself to really expand your portfolio like you did? Like, kind of what was the commitment you had to give?
Yeah. So our goal before I lost my job was, hey, we got a really healthy salary coming off of this job, and I already had a plan. I was gonna leave that job anyway, but my I had like a 5 to 7 year plan, right? It's like, based on what I'm making, like I should be able to comfortably get out of that job in 5 to 7 years. It just accelerated that. So then all the money that we had saved up, that became our money for paying the mortgage, buying groceries and just like sustaining our life. So we made the strategic decision to say, we're going to keep scaling, but we're going to do it by partnering with other people. And that's what we did. So we leveraged this brand that we had been building, to identify folks who liked the idea of investing in short-term rentals, but they lacked the time, the desire, the ability to do it themselves. And we pretty much did all the hard work. We found the deals, we sourced the deals. My wife and I would have mountains of boxes showing up at our house. We'd fill up a U-Haul, drive down and spend a week, setting up all these different properties. So we really just did all the work that the people didn't want to do. In exchange, they covered the down payments, they carried the mortgage, and they were like the financial engine to that scale. And obviously we split the profits, but that's how we were able to scale so quickly.
I love that. And yes, as Adam mentioned, capital is the most limiting factor. So
Yeah.
scalability, as you mentioned in the very beginning, Tony, no one's going to retire off of one property, right? It's a numbers game, a scalability game. And so leveraging partnerships is huge,
Yeah.
as you run out of your own capital. But you're partnering with people, and you're not just leveraging like the capital, they are leveraging your experience, right?
Exactly.
And you got obviously have a track record with that. So I think that's super interesting. I'd love to hear about, like, you touched on this a little bit about what a deal structure looks like.
Mhm.
but just for someone who may be possibly interested in partnering with you, like what does a typical deal structure look like, just to give them more details?
Yeah, I mean, I feel like it varies a little bit, and we've done it in so many different ways. We have some deals that we've done where it was just debt based, and those money partners, they don't have any equity in the deal, but they get a nice fixed return on their investment. We pay them back in 6 to 12 months. We've done equity deals where it's just down the middle, 50-50. Our first commercial purchase, our money partners own 70%. We have 30%, almost more typical of like a syndication. We get some additional fees for managing it and whatnot. So I think it depends on the deal, depends on what we're looking at. But I think the biggest goal for us is understanding, hey, what are your goals as the person with the capital, and what are you looking to get? Do you want something long term? Do you want something short term? Do you want something bigger? Do you want something smaller? And then kind of pairing them up with the deal that we have in the pipeline that makes the most sense.
Yeah, I mean that's huge, and thank you for calling that out. That is unique to each particular deal. I mean,
Mhm.
partnerships are the sky's the limit. You can structure, and every partnership may be different based on what the goals and objectives of each party, and what makes sense to the partnership. My brother-in-law has purchased a lot of houses through our network and on his own, where
Mhm.
he doesn't put any of his own money into it. He brings in the capital, brings in the financing
Mhm.
with it, with people that want to invest in real estate. They want nothing to do with it. They want to
Mhm.
diversify their portfolio, and they share split profits down the middle, 50-50. So that is just a really unique way to leverage partnerships, and you guys have certainly done that in a number of ways to help grow your portfolio. Um, let's talk. Well, just real quick, I would I would be upset if I didn't ask if you're doing the cost eggs on these
Mhm.
things, and how that works. And we're all hoping that we're going to be back at 100% bonus this
100%.
year.
Yeah, I mean that's honestly also been, I think, one of the biggest benefits for us is that we have done cost segregation studies on virtually every single property, and it's allowed us, even as our income is scaled, to really not have to worry about now federally, I should say, not really have to worry about a tax bill. But I'm in California, so I can't really escape the California taxes. But yeah, it's one of the biggest benefits to investing in short term rentals is the ability to dramatically reduce how much you pay in federal taxes.
Huge. Plus all the furnishing, like those are all expenses, right? You
Yeah,
guys have
absolutely.
so many write-offs. Tony, let's fast forward to where you're at today. We want to talk about the boutique hotel stuff. So
Yeah.
just give a snapshot of all the cool things you're working on today.
Yeah, I just think there's an amazing opportunity in the kind of small boutique hotel motel space right now. There's an entire generation of owners that are retiring, and their children don't want to run this, mom and dad's pet project. And we've just seen that there's a massive opportunity to get these properties. Again, our kind of buy box right now, we're looking at 10 to 30 rooms, that like 1 to maybe 3 million purchase price. And there's just a ton of them out there. And what we found is that there's a strong appetite to offer seller financing at pretty good terms for a lot of these. So much so that we're only looking at properties that will entertain seller financing offers. So that's kind of what we're focused on right now. We launched our first one again about a year ago, and I think one of the mistakes, or not mistakes, but one of the pains that we had at scaling so fast on the single family side was that a lot of things broke as we scale, and we had a lot of self inflicted headaches. So we're trying to learn from those lessons and scale a little bit more in a slightly more controlled fashion on the commercial side. But yeah, that is the goal for us, raising capital for more of these boutique hotels and motels.
What have you found as you're, expanding? You went from long term, short term, now boutique hotels. How has your due diligence changed? How have you, vetted out the markets that you're
Yeah.
doing it in? Because you can't just say, oh, well, this would work as a long term rental market. Surely a boutique hotel market's going to be great for it. So, what are some of the ways that you've evaluated deals that have had to change over time?
Yeah. So in terms of market selection, like and it's slightly different than someone who's like an apartment syndicator, right? Like if I'm an apartment syndicator, I can say we focus on DFW, and I can just look for deals in DFW. But when we're looking for such a tight buy box, again, 10 to 30 rooms, 1 to 3 million purchase price, seller financing, value add, I can't just say DFW, right? Because I'll buy maybe one deal every X number of years. So we're really looking nationwide, but we're focusing on types of markets. So ideally for us, we're staying away from rural markets. We're staying away from suburban markets. And we're really just focusing on either urban centers or true vacation destinations, right? So the first hotel we bought outside of Zion National Park, that checks the box for vacation destination. So that's what we're looking for. And actually, one of the things that I've learned as well is we're kind of evaluating the markets. And I didn't learn this until after we bought the first one, but getting a better sense of what hotel construction is in the pipeline. So after we bought that hotel in Zion, we just happened to be talking to someone else in town and found out they're building 2 more hotels, like massive, like franchised hotels in that town, which obviously makes me a little bit nervous, right? Because it's like, okay, what's going to happen here? Now, hopefully demand will continue to increase as those complete, but that's also something I'm looking for. It's like, okay, not only what's the current supply of hotels, but like, hey, what's in the pipeline? What's coming down the road? So we're looking for certain, does it fit the mold? But then we also want to know, like from a data perspective, what are we competing against?
Yeah, that's interesting that all of a sudden they're popping up these huge hotels. But Zion's awesome, and it's hard to find. That's a place we frequent every year. Got to hike Angel's Landing if you haven't. When you stay at Tony's Hotel, that's a super cool area, but it's so hard to find accommodations there. Mm-hmm. It is so hard. So, but I do think that like being unique in your hotel and the boutique space like will allow you to stand out, right? And I think there's a lot you can remove from the competition, as we've talked about before, and you've already done in all the other markets. Tony, my last question for you, I want to go back to the beginning. A lot of our audience are people that they're probably under 10 doors. They're in the scalability mode, or a large portion of them are going for like from 0 to 1, and they're looking to get that first deal done. So I just want to go back up all the way to the beginning. You've had great success in real estate, and you continue to influence and help other people accomplish their goals, and help people be successful in real estate. But why? Let's just go back and just talk about the why again. There's a lot of different things you can do in business. There's a lot of different things you can invest in. A lot of different ways to make money. But why did you ultimately choose real estate? What was it about real estate? And how do you really like for someone that you're speaking with that's kind of on the fence of like, is real estate even the right thing for me to do? Like, what would you say to that person?
Yeah. I think for the person that's on the fence, the first thing that I would say is maybe real estate isn't the right thing for you. And that's okay. But you've got to ask yourself and be honest with yourself. What is it that you're looking for? And I think that for anyone that's looking to invest in any asset class, you have to ask yourself what your motivations are. And those motivations can typically be bucketed into, one of few categories. There's the cash flow. There's appreciation or equity growth, right? There are tax benefits. And then maybe a fourth category, like if you're looking at short-term rentals like me, it's the lifestyle component, right? Being able to use these assets yourself, right? So cash flow, equity, tax benefits, and lifestyle. And just assess whatever investment you're thinking about against those 4. Now, I think where most people get caught up is that they try and equally weigh those 4 things. But the truth is that no investment typically is going to like equally hit all of those buckets. So you've got to forcefully rank what is my most important, what is my least important. And if cash flow is your number 1 and you don't care about tax benefits, you don't care about equity growth, you just want money coming in every single month, then maybe you do go buy a small business. Remember, you buy a car wash, whatever it is. But if you want, in addition to cash flow, if you want some sort of tax benefit, if you want some sort of appreciation long term, if you want to be able to stay there, I guess you could sleep at your car wash, but it doesn't sound like a good time, right? If you want some sort of lifestyle component, then maybe real estate does make sense. So I think, I don't know if I can give just like a blanketed answer, but it's like answer those questions for yourself. What are your motivations from most important to least important, and pair those investment opportunities up against those motivations.
And was that the case for you? Did you go through that? Were you aware of all those things when you decided to start investing in real estate, or what was the decision for you to intentionally start buying real estate?
I think for me, my dad, when I was younger, this was right before 2008. So I want to say like 2004 up to the 2008, 2009 crash. He was in trucking most of my life, but he made a bet on himself. He and my uncle started a wholesaling business, almost similar to what you guys are doing. They were helping investors in California buy turnkey properties in Detroit. And he was kind of working as a middleman, but they wouldn't manage it. They would just kind of help set the deal up, manage the rehab. And they were doing incredibly well for 5 years. Then 2008 happens. They lose their business, right? And he told me as he was going through that difficult time, he said, one of the mistakes I made was that I didn't hold anything. It's like I had all these deals kind of moved through my fingers, and transactionally we were doing great, but like there was no residual income. And he was like, son, if there's one thing I can tell you, it's like buy assets and pay you every single month. And that stuck with me, right? So like, again, once I got old enough and had enough money in my bank account, that was the message that was in the back of my mind. It was like, hey, let's get some assets that are going to produce income monthly in addition to those other things. And it just felt like real estate was the right bet for me.
Perfect. Well, if you're going to ask the question of the newbie investor, why not ask it to the co-host of the Real Estate Rookie podcast?
Yeah, I've had a little bit of practice answering that question.
Well, excellent. So again, Tony is the co-host of the Real Estate Rookie podcast, one half of the Real Estate Robinsons. Tell our people where they can find you. I know you've got an Instagram handle and all of that. So tell people where the best place to find you is.
Yeah, the best place, Tony J. Robinson on Instagram. You can find me there to link out to everything else. But as we said at the top of the show, co-host of the Real Estate Rookie podcast through BiggerPockets. And then my wife and I have the YouTube channel called The Real Estate Robinson. So any of those places will be good to find us.
Fantastic. We will have all of those listed in the show notes. But Tony, really appreciate you taking the time to join us today and talk to our investors about all the things they can accomplish in real estate, the things you're doing. Incredibly interesting, and we look forward to hearing more about it as we go through time. So for everybody, if you want to see some assets that you can control long-term through us, you can head on over to renttoretirement.com and check them out there. You can book a time to talk with us. We can help you through kind of planning out your portfolio long-term. If you want to ask us any questions, or if you want to come on here and tell your story, you can email podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. And we will answer your questions in future episodes. To everybody else, thanks for taking the time to educate yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.